Last time when we interacted on the same forum, you were bullish on mid-cap stocks, and you clearly made a case that mid-cap stocks will outperform large-cap stocks. Do you think for 2013 large-cap stocks could bounce back?
That seems to be the trade. I think that seems to be the obvious kind of a trade that I think one is that of course mid-caps have rallied significantly in 2012. That's clearly visible in the differential performance between say the BSE mid-cap index and the BSE Sensex.
But the P multiple for the BSE mid-cap index is still at a discount to the Sensex.
In fact, given the outperformance which has happened in the recent sessions, the mid-cap index has now started to trade at a marginal premium to the large caps, and that's because the mid-cap index has done pretty well in the last couple of months. So it's because of that, and that's a relatively rare situation to be in, where the mid-caps are at premium, and I think that's true globally. I mean, I was reading somewhere that the FTSE mid-cap index trades at a substantial premium to a comparable large cap index. So I think there's been a global rally in mid-cap, small caps, and that's maybe because they were beaten down in 2011. That's not the case now. So it's quite possible that maybe if you're taking a relatively shorter term horizon, it's quite possible that there's a case for large caps to do better than the mid caps, especially if the markets were to get into some kind of a correction mode. I think if the markets were to continue to rally, then maybe the mid caps will kind of play a catch up game, do well. But if the markets were to get into some kind of an intermittent correction mode, then it's quite possible that the large caps will end up being more defensive lot and could outperform the mid caps on the way down.
Irrespective of global news or local news or global news, do you think 5500 or 5400 will act as a solid base for the Nifty?
I believe so. I think 5500 I think is a possibility, can be a reality, and I think at that kind of levels the valuation support would be fantastic, because let's look at it. I mean, at 5500 on the Nifty, which is a 10% lower from here, we're talking of roughly the Sensex at 18,000. If we're at a situation where next year the Sensex EPS turns out to be about 1350 or so, we'd actually see the market trading below 15 times, which is below its long-term average. I think that's a great situation to be in, because we're convinced that over the long run, over the next many years, the Sensex valuations would start commanding a premium to the long-term averages based on various triggers, various catalysts, and the long-term growth potential. So I think those kind of levels, the valuation comfort, valuation support would be awesome at those kind of levels.
At 5500 or at 18,000 on the Sensex, would you plow in all the cash what you have?
I think, I mean, you'd essentially kind of, change your bias and say that, yes, I think at these kind of levels, you really want to kind of get more aggressive in terms of deployment. You'll really start, see that the ideas that you've been hunting for, or you've really been having on your radar, do they offer, meaningful value? And I think if they do so, then I'd use the cliche that you'd want to really make a disproportionate allocation.
Where are you allocating disproportionate amount of money then?
Mid-cap or tier 2 technology companies which are having their own niche, and I think are doing a commendable job for many years, and I think are led by exemplary managements. I think those are the kind of companies that we're focusing on, which are trading at a discount to the large cap. So clearly what we see is there's a valuation differential, there's a valuation gap with better growth prospects, and I think that's clearly the segment that we have focused on, where we're seeing that we'd want to kind of really look and see more names choose and invest out there.
How much of your portfolio is currently invested in IT?
I think that's our largest sector. Let me put it this way, that's really where we have the largest allocation to. That's clearly our number one sectoral bet at this stage. It's not just the sector, but I think the kind of individual companies that we like out there, because of which the allocation is clearly the number one in terms of the sector.
Your big call for 2011 was to hide in defensives. Your big call for 2012 was to buy financials. What is your big call for 2013?
I think the big call for 2013 is, I think, one is avoid sectors which are overvalued or have had a steep run, and on the other hand, bet on companies where you believe that there's a good chance for those companies to restructure balance sheets, because they'll clearly be emerge the winners post 2013. Companies which are going to be sunk in debt, I think for them the chances of a revival and ride the growth would be very limited.
Bet on bear market survivors.
Absolutely. I think, and I think just, yes, one is the market, but two is managements who have willing to take tough calls, let go of businesses which are non-core, let go of assets to raise cash, retire debt, reduce debt, and have a leaner balance sheet. I think those are the companies which are going to be winners post 2030.
So recovery and restructuring, these are two themes you should focus on.
Absolutely. Absolutely.
Now, there are two special situation stocks, Wockhardt and United Spirits. These were clearly two special situation stocks for 2012. For 2013, give me a list of special situation stocks where you're confident of a recovery or a restructuring.
Well, at this stage, it's hard for me to really say that.
You've done your homework. Are you trying to dodge my question?
No. But I'd probably say that, okay, let's look at the infrastructure space. I think that's clearly where the big, I'd say the big challenges are there, both at the macro level as well as at the companies level. Now, you have companies like, say, GMR, GVK, for example, okay, who are walking out of road projects. Okay, and when they're walking out of road projects, which means that the need for capital could be very limited. Yeah, and if they're not taking on new projects, and that seems to be the current mood if one reads what's really there, then it's quite possible that their need for capital would be very limited, and it's quite possible that they would be able to some extent reduce their debt. And there's a lot of bad news which is there around these companies. I mean, we've seen what kind of negative events which have happened for these kind of companies. Now, if these kind of companies during the course of the year are able to restructure their balance sheets, okay, it's quite possible that they could end up being, those contrarian bets or those special situation stocks.
Nilesh Shah, I know, is not a typical value investor. You've always been a growth investor. You are always hungry for new ideas. You always try to find multi-baggers. Give me a list of stocks which could be multi-baggers in making. I'm going to keep the time frame open. 2 years, 3 years, 5 years, you pick and choose.
Now, I think from the next 3 to 5 years, I think something which is a reality is essentially Aadhaar, which means more money in the hands of the household. And you could end up seeing households receive anywhere between, say, 2,000 rupees to 7,000 rupees a month, depending upon where all does the government decide to have direct cash transfers. And I think more money means more spending. And clearly I believe that consumer durables is one big area over the next 3 to 5 years where the demand could be very, very strong. And I'm saying this in a backdrop where the last 2 years have not been good for consumer durable companies in terms of demand. So you have two situations where Aadhaar gives more money to households, and two is that there's a potential pent-up demand. And I think if both of these converge over the next few years, I think as a sector it has tremendous potential.
Last question, no trick question this time. What is your largest holding?
It's a technology name. So the largest position that we have is on the technology area. It's a tier 2 technology company. So yeah.
Okay, Nilesh, we'll leave it there. Appreciate your time and thank you for joining us.
Thank you, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.